Welcome back to the series of videos that explain how to complete the financial statement and analysis spreadsheet system. This spreadsheet is part of the University of Wisconsin's Division of Extension's Farm Management Pulse program. The full curriculum and spreadsheet can be found at the website addresses that are shown on the visual. My name is Kevin Bernhardt, and I am both a farm management specialist for the University of Wisconsin Extension's Division of Extension, and I'm also a professor in the School of Agriculture at UW-Platteville. This video and the next one after that focus on some of the challenge areas of the income statement. Particularly, this video is going to cover hedging income and losses, and the following video will talk about breeding livestock sales, gain and loss from capital asset sales, and also gain and loss from a change in the base value on raised breeding livestock. But for this video here, we're going to talk about hedging. So let's get started. Hedging is a tool that's often used for price risk management. Very common among farms of both grains, milk, cattle, and so forth. But the question is, how do we record any incomes from hedging or any losses from hedging on our income statements? Well, the following visuals kind of give us a little bit of a feel for what we're talking about, first of all, when we talk about hedging income and losses. So if you are hedging a commodity, that means you've gone to the futures market and either have originally sold or originally purchased a futures contract. If you're wanting to protect the price of something that you're going to sell in the future, that's the examples I'm going to be showing, then you originally sell a futures contract and later on you're going to buy that back. So in our example, we're selling one 5,000 bushel corn contract for $5.50. We're going to buy, and we end up in the end, we don't know this to start with, but as the months pass, we buy it back for $5. Well, that's a 50 cent per bushel gain. We actually got 50 cents out of the market on all 5,000 of those bushels, or in other words, $2,500. So where does that $2,500 go? Well, we have to have a brokerage account whenever we have a sale or a purchase of a futures contract. And so that money, that $2,500 of income, goes into our brokerage account. We have the choice as the farmer, we have a choice of either leaving that there, or we can actually pull it out as a withdrawal and use that money elsewhere. By the same token, it can go the other way around. So we could sell 5,000 bushels of corn for $5.50, but later on, when the time comes to buy that contract back, prices might have risen and might be worth $6 per bushel now, and we're forced to buy it back for $6 a bushel. That means we lost 50 cents per bushel, or in other words, for 5,000 bushels, that's a total of $2,500 of losses. Now, where does that money come from? That money comes directly, it comes from our brokerage account. But of course, we have to, as the farmer who owns that brokerage account, we have to provide the money into that brokerage account. So we would have to probably deposit that $2,500 into the brokerage account so that it then can go to whoever earned it somewhere else in the world. So how do we take this together and figure out our cash hedging income and losses? It's actually quite simple in terms of the spreadsheet system, but a little bit complicated in explanation. What you see in the middle of the visual in that orange shaded part is what the formula is for cash income statement hedging income or losses. And it's the ending balance of the brokerage account minus the beginning balance of the brokerage account, end of the year minus the beginning of the year. And we're going to take whatever that difference is, and we're going to add to it the withdrawals that we have made from that brokerage account minus the deposits that we have put into that brokerage account over the course of the year. So if you know what your beginning balance is of the brokerage account, if you know what your ending balance is of the brokerage account, if you have records of the withdrawals you've taken and the deposits you've made, all of these things can be found on your brokerage statement, by the way, then you can be able to calculate what your cash hedging income and losses are. So what happens on the accrual income statement? Well, for the accrual income statement, we have to do a little something extra. And that is we have to look at something that's called marked to market equity of an open position contract. Now, what that is a contract that has been originally sold or originally purchased. And at the end of the year, it hasn't been closed out yet. It's still open. So whatever the value is at the end of the year, that can either be a positive value or a negative value. That's referred to as the equity in that contract, or the terminology is the mark-to-market value of that open position. So for example, if we initially sold a contract for $5.50 during the year, we get to the end of the year and we haven't closed that position out yet, then what goes on our income statement is the equity value of that contract. In this case, it's a positive $2,500 because we've earned 50 cents. Now it could go the other way and we'd have a negative mark-to-market equity value. But that is money that we haven't received in cash yet, or we haven't paid out in cash yet. But if we were to close the contract today, which is what the balance sheet shows, that's what the income or loss would be. And that's what we want to record on our accrual income statement. So here's how that formula looks. The beginning part, again, I'm just focusing on the middle part here. The first part of it is the same. The first two parts are the same as what we had for the cash income statement. So it's the ending balance of the brokerage account minus the beginning balance of the brokerage account, plus withdrawals that we've made minus deposits. That's the same as before. But now with the accrual income statement, we want to add this last part, which is the ending mark-to-market value of any open positions that we have, minus the beginning value, mark-to-market value of any open positions we might have. Okay, so what you have in front of you is the cash and accrual income statement that you've seen many times at this point now. And the line item that we're referring to is right here. It's called hedging income. And we want to complete the income statement schedule 1 ultimately. But what the cash income statement shows is a negative $33,344 for our case study. And the accrual income statement in column G here shows a negative $10,904. Now, where do these numbers come from? Well, you saw in the PowerPoints the formulas for getting those numbers, but we have that in the spreadsheet itself. So most of the numbers are available automatically if you've completed the beginning and ending balance sheet for this particular, for your farm. So let's take a look, and you can see the instructions tell you to go to income statement schedule 1. And we go down below, there's our tabs. And here's the income statement schedules. I'm going to click on that. And we're looking at, I'm going to make this a little bit bigger so it might be easier to see. And this is hedging income schedule 1 is in this block right here that I'm circling. And how this one works is the only entry that's needed from you, the user, is in those yellow shaded cells. So if you have taken a withdrawal from your brokerage account, the sum of all withdrawals for the year would go in this cell right here, cell, in this case, it's D4 for this version. If you've had any deposits that you've made to that brokerage account, in this case, our case study farm made $3,000 deposit into the brokerage account. That's where that would go. Where do you find these numbers? Get a hold of your broker. They could tell you what it is, or review your brokerage statements that you've gotten over the course of the year. That will tell you as well what your total withdrawals and total deposits have been. Now, as you can see, there's some other numbers here. There's 4 others in particular. The beginning brokerage account balance, the beginning mark-to-market value, the ending brokerage account balance, and the ending mark-to-market value. Those numbers are not yellow shaded, so they've come automatically from somewhere else. And where they've come from is the balance sheet. So for example, the beginning brokerage account is $38,450. The ending of the year brokerage account balance is $8,106. If I go over to the balance sheet, I'm down below here now in the tabs again, and I'm going to click on the balance sheet. And there's that 30, here it is, hedging brokerage account balances, line 8, and it's 8,106 for the end of the year. It's 38,450 for the beginning of the year. And ultimately where those numbers come from is when you can remember, when you do the balance sheet, you're not actually entering numbers on the balance sheet itself. What you are completing is the balance sheet schedules. So if I go down below here again and click on the tab that's called balance sheet schedules, then I will see here the hedging account balances. So this is for the current year, the end of the year, if you will. And the hedging account, we have Kapka Brokerage, and we have an account with them, and there's $8,106 in that. And that $8,106 automatically goes to the balance sheet, and it also automatically goes to the income statement schedule, 8,106, for the ending brokerage account balance. The same is true for the mark-to-market value of any open positions at the beginning of the year, negative 25,840 in this case, and the end of the year mark-to-market value of any open positions, which is negative $3,400. Where do those numbers come from? Again, I'll go over here to the balance sheet, and there they are, mark-to-market value of open hedges, line 9 in the balance sheet, $3,400 for the end of the year, negative $25,840 at the beginning of the year. And those numbers as well then come from having completed the balance sheet schedules. There's a negative $3,400. We have an open soybean contract in this case. So that's where the numbers all come from. So really, in terms of completing the income statement, the only thing that you really need to do as a user, once you've completed the beginning and ending balance sheet, the only thing left to do is enter whatever withdrawals that you've had, enter whatever deposits you've had into that brokerage account, and all the rest will be calculated for you. You can see those in the blue shaded cells here. That's the results for the cash income statement and for the accrual income statement. And then those numbers get transferred over to the appropriate place on the income statement itself. So that was a long way around to just letting you know that you only really have to enter 2 numbers there. The one other thing I would say about hedging income is your hedging income could very likely be included on your Schedule F, the cash part at least, on your Schedule F in the other operating revenues, which I think is usually line 8 on the Schedule F. So that's something, sometimes it's included there and sometimes it's not. You'll want to make sure what the situation is for your farm and act accordingly for that. So you don't want to double count other operating revenues that have hedging income and then also do it here in this spot as well. So if it was in the other operating revenues on your Schedule F, that's going to end up showing up here in this line 17, other operating revenue. So that's one thing to be careful of, that you know where your hedging income and losses are being reported. That is all that we need to say, I think, about hedging income and losses. That ends this video. Our next video is going to be about how do we make the entries for breeding livestock and for gain loss on capital asset sales. Until then, thank you for listening.